Hi, I'm Max, and in this video, I'm going to tell you how, as a business owner, you can get money from your business into your personal name while reducing your corporation tax. I help business owners reduce the amount of tax they pay, protect what they have, plan and invest for the future. And 99% of the business owners I work with are extremely busy on their business and often neglect their personal finances. And because of that, they miss out on some of the things you can do to help reduce that tax that you're currently paying. So to explain how this works, I'm going to be jumping onto the iPad and talking you through it with some writing. The overall goal for most business owners is to profit from it. And this is a way of being able to extract some of that profit from the business into your personal name. So the majority of business owners are pretty efficient with the way they pay themselves. They've got a salary and they're paying themselves as dividends because, as we know, the dividends are taxed at a lower rate than income, which is one of the benefits of operating as a limited company. Now, this is great. Doing this is a pretty efficient way of paying yourself. But there's also a third way where we can also get money out from the business into your personal name, and that's through using a pension. Now, when you contribute from your business into your pension, this counts as a business expense. And so it's going to reduce that profit level that you've got and therefore reduce that corp tax as well. So this is a really powerful way of getting money from your business into your personal name. So let's just talk through a bit about the pension. So the pension is really just a box that holds an investment. And that is really the purpose of a pension. So this pension just has different tax rules and regulations around this box. So that's basically just the way to think of a pension, a really simple way of thinking of a pension. In terms of what this investment is going to be, we'll talk about this towards the end of the video, but let's just talk through some of the benefits that come from the pension. So you get £60,000 allowance per year that you can contribute into. This, as I said, if it's wholly and exclusively for business purposes coming from your company to yourself, then this will be a business expense, which is great. If you're the sole director, then it's almost definitely going to be wholly and exclusively for your business purposes because you're the only person within that business. If it's perhaps you and your wife, or perhaps you have a couple of other directors, shareholders within the company, then it's definitely worth speaking to your accountant in terms of whether it passes the wholly and exclusive. So as I said, you've got a £60,000 allowance. So if this was going to be taxed at 25% corp tax, you've saved yourself £15,000 by contributing £60,000 from your company into your pension. And you can do this every single year. If it's you and your wife who are in the company as directors, then you can times that by 2 and you're saving yourself £30,000, which basically the option is you either pay the corporation tax or you put it into your pension and you save that money. So it becomes a bit of a no-brainer. So this is that relief that you're getting, that tax relief in terms of corporation tax. This does differ slightly if you're a sole trader, and I'll do a separate video on that. But if you're a director of a limited company, this is this relief you're getting. But not only that, is these investments that we've got in here is going to be growing tax-free. That means each year when that's invested within the markets and that's growing and earning an interest or earning return or earning dividends, when that accumulates every single year, you're not being taxed on any of those gains or those profits within that. So that's a really powerful thing as well. And as we know, the longer you're in an investment over time, the longer you have compound interest helping you and being your friend. So this is a really powerful thing. Now, the accessibility of this is something that some people worry about. So at the moment, your access is 55 and this is raising to 57 in 2028. So for some people, this is a positive, and for other people, this is a negative. And what I mean by that is some people like the fact that that is locked away until that age. So that means that that compound interest we just spoke about can really take effect, and it is a longer term investment strategy because of that access. Now, for other people, that is a bit of an issue because they want that money in 5 years' time or 10 years' time. And in that case, you sort of have to rethink how much you're going to put into your pension and whether this is the best. So as I said, this is either just a positive or a negative. It's just one of those rules and regulations that happen with the pension. Now, when you can access that, what happens? So you can have 25% tax-free on withdrawal, and the rest is taxable at your marginal rate. Now, what you can do is what's called flexi access drawdown, which means that you can take 25% and keep the rest invested, and then take that when you need it. That is one of the most common ways of doing it these days. And of course, you can be clever with the way you take this for your marginal rate so that you're paying as little tax as possible. One of the other great benefits, and for a lot of the clients I work with, they actually see their pension as not theirs. It's a way of passing on wealth. And The reason for that is because if you die before age 75, your pension passes on tax-free, which is extremely powerful, because if you've got £1 million sat in your pension and your whole estate is worth more than £1 million, the chances are you're going to have some inheritance tax to pay. But your pension isn't included in your taxable estate. And so if you die before age 75, it passes on tax-free. And if you die after, then it passes on at the marginal rate of the recipient. So again, potentially paid a lot less tax than. What is important with this is that you have an expression of wish form filled out. This is basically going to tell that pension provider where and who you want that money to go to, which is really important that that gets done. It's also important to check that that's up to date, because if you potentially had a divorce or things have happened and you want that money where you previously said for it to go is now changed, then you're going to want to change and update that. The other thing you can do is put this pension within trust, which is something that I do with all my clients. Make sure that they've got a trust set up with the pension, they've got an expression of wish form as well. So those are some of the benefits of the pension. And as I said at the beginning, it becomes a bit of a no-brainer that if you're paying huge amounts of corporation tax, you've got a lot of cash sat in your business, then utilizing the pension or paying from your company into that pension is a bit of a no-brainer. Now, it becomes even more of a no-brainer when we know that that was actually invested in a tax-free environment that we spoke about. So the big question is what are we going to invest in? Well, this really depends on the individual and you, what you're trying to achieve, but also what your risk is, because it's the amount of risk you want to take on is going to dictate what investment you have and where that's invested. But in general, what you want to do is diversify where this investment is across the globe, potentially diversify in different asset classes. But the important thing to do is to make sure that what that is invested in matches the risk you want to take. You don't want to be in a portfolio that's extremely low risk when actually you want to take on high risk, or you've got a long time horizon for this investment as well, and then vice versa. If you want slightly lower risk in terms of the investments that you've got, you don't want to be in a portfolio that's quite high risk. Lastly, in terms of the pension, if you're doing this yourself and you want to make sure that you're covered by the Financial Service Compensation Scheme, it's really important with the pension side of things that it is with a scheme that's protected under the FSCS.